I'm Luben Pampoulov, co-founder and partner at GSV Asset Management, and what you just saw was earlier this week at the Apple Developer Conference, basically the video on the Apple App Store. I'm going to present on 4 of our later stage companies, which are all very popular apps in the App Store, and I'm going to talk about essentially what are some of the key fundamentals we see in those companies, what is the competitive landscape, and what are the near-term drivers that we see. Starting with number 1, Spotify, which today is 8.6% of our net asset value as of the end of first quarter. One of the key fundamentals there is an exceptionally strong management team led by founder and CEO Daniel Ek. He has managed to keep Spotify well ahead of everybody else in the music space, and also to transform the music space, when you think about what it was 10, 15 years ago to what it is today, essentially on demand in your pocket. Another key fundamental that separates Spotify from its competitors like Apple Music and others is the quality of the service. The company uses AI and kind of personalized analytics to create very personalized experience on Spotify, and so some of the services that have become extremely popular include Release Radar and Discover Weekly, which are key fundamentals to the company, and we expect to see more of that going forward. Then obviously the user base, which is growing and in an accelerating trend. Most recently, they had announced 50 million paid users this year in February, which was up from less than 30 million a year ago, and obviously with a very strong growth rate. And then additionally, the company recently started to create their own content and also to focus more on video. So these are other key fundamentals that going forward will kind of lead the company. In terms of the competitive landscape, very obvious big competitor is Apple Music, which feeds off of an iTunes user base of more than 800 million users. Earlier this week, Apple announced that they had passed 27 million paid users with Apple Music, so essentially half the size of Spotify. I think Spotify has done a great job over the last 2 years to kind of keep Apple at a distance, and that's basically visible now with the new numbers. Pandora, while successful 10 years ago, doesn't seem to be too big of a threat. Most recently, if you follow their announcements, the active listeners and also the time spent on Pandora has been declining. Spotify obviously growing at a very strong rate in the opposite direction. And Tidal and SoundCloud, 2 smaller competitors that Tidal recently got acquired. SoundCloud is looking to be potentially acquired or to do a new funding. Not seeing those really as big competitors. YouTube, together with Google, could over the next few years become a bigger competitor than it is today. There are some rumors that Google Music will be merged with YouTube later this year. So that's one that we are watching and obviously analyzing. We think Spotify's near-term drivers will include, on one end, the negotiations with the big 4 labels. If you followed press releases most recently, Spotify was able to successfully renegotiate 2 of those, and is in the final stages of doing the other 2. So we expect that once all those label negotiations are done, there's going to be a significant uptick in the margin structure for Spotify, potentially to get to similar levels to those of Netflix. Also focusing more on the developing world is something that Spotify now has as a primary focus point. Last year they expanded into Indonesia, they launched in Japan. 2 weeks ago they announced they're going into Thailand and Vietnam, and there is a high likelihood that they will also target India in the near future. Then video and original series will continue to be a driver as they expand the platform, and obviously maintaining high engagement, user growth, and growing the platform is going to be key for Spotify. Moving on to the next one, Dropbox, which as of the end of first quarter was 6% of our NAV. Same thing here. One of the key fundamentals of the company is a very strong management team led by Drew Houston, who has managed to specifically over the last 2 years hit several major points, where the company is basically getting ready to go public at some point over the next 12 months, most likely. Those milestones include the company announced they were free cash flow positive a year ago. They also announced in January this year that they became the fastest SaaS company to hit $1 billion in annualized revenue run rate. And just in April, they announced that they hit EBIT profitability. So all of those milestones place Dropbox in a very strong position should they choose to go public soon. Additionally, another thing that's happening is Dropbox is moving away from being a single service to more of a platform business. And earlier this year, Dropbox announced SmartSync and also Dropbox Paper. Both of those products are essentially there to increase productivity among teams and among bigger corporations to collaborate on projects, to collaborate on documents, and so forth. And we expect that there's going to be a bigger emphasis on the platform business going forward. In terms of competition, Box, a very obvious competitor, is less than half the size of Dropbox as of the last quarter. When they reported, they were on a 440 million annualized revenue run rate. Another company that could potentially become a stronger competitor over time is Google Drive, which obviously has a large user base just from single users now at over 800 million users. But they've also recently started to focus on corporates, so this is one that we're watching out for. And then just the traditional file sharing and storing services that still continue to exist in the corporate world is something else that still is kind of a competitor, but which is getting disrupted by Dropbox. In terms of near-term drivers, we believe the mix of profitability and ongoing strong top-line growth will be key. The majority of Dropbox revenue is organic and inbound, which is very different than most of its competitors and very positive. The shift from single service to a platform business, obviously, and also, continuing to bet on a very strong management team there. Going over to the next one, Lyft, which today is 3.3% of our NAV. The one key thing that really has kept Lyft, become a very strong brand is its management focus on the culture and on keeping a brand that's distinguishing, and that for very obvious reasons there is Uber, a very huge competitor, which when we made our investment about 4 years ago, was significantly larger in terms of market share in the US than Lyft. And so if you just look at what Lyft has done in terms of brand and culture, they've really managed to kind of separate themselves and be that kind of the cool brand in the ride-sharing space. To that end, they've been obviously very focused on kind of branding and marketing, and I want to show 2 quick videos of a recent marketing campaign. Can we have sounds?
So happy. Maybe it's because Lyft.
Okay, I'll have to play it again.
Chicago, Miami, Seattle. Look at the smiley people in Seattle. Why are all the Lyft drivers so happy?
Maybe it's because Lyft lets passengers tip them in the app.
It's gross.
I heard Lyft paid out over $100 million in tips to their drivers.
Well, that's just stupid.
Why would you do that?
They used the extra money to buy gifts for their family.
So I'll let you guess who that management team might be. Here's another one.
Look at this.
These Lyft drivers are picking up people quick.
How quick?
It's like 3.5 minutes.
It's too fast.
Way too fast.
We gotta slow them down. How are we gonna do it?
Spike strips.
No,
Lasers.
I don't understand that.
Cattle on the road.
Maybe. What else?
Tryptophan.
Like turkeys?
Yeah.
Just put it inside the driver.
Pop it in.
I love it.
By the way, reminds me of Apple in 1994. Obviously, the fundamentals, John Zimmer and Logan Green, exceptional founders and kind of CEOs of the company. Lyft has had a higher growth rate than Uber ever since we invested in the US specifically and continues to gain market share. In terms of competition, this year specifically, it's been great for Lyft, not so good for Uber with all the bad press and bad developments that are going on the legal side and on the popularity side and so forth, but a very obvious big competitor. And then still there is kind of the taxi industry that still tries to slow down things for both Uber and Lyft, and that's another competitive threat that continues to be there. Near-term drivers, as Michael previously mentioned, and the company reported 160 million rides last year, which tripled from 2015. This year, they already reached their annual goal for 100 new cities already in March, and they're outperforming expectations by about 30% so far. And some of the near-term drivers will be on this, obviously the self-driving technology and some of the partnerships they struck with General Motors, Waymo, and yesterday they just announced Nutonomy. So those will be near-term as well as long-term drivers as those companies are shifting towards self-driving cars. And the last one I want to talk about is one of our companies that's public now, Snap, which is 2.7% of NAV. We think that its founder and CEO, Evan Spiegel, has truly the potential to become one of the next Steve Jobs, Bill Gates, and Mark Zuckerberg type of people. Snapchat has been an exceptional kind of company that has really transformed social media and personalized sharing towards self-broadcasting in a totally new way. Just looking at the user base, most recently they announced 166 million daily active users, which was, they saw a slight uptick compared to the previous, to the fourth quarter and slight acceleration. We hope to continue to see that going forward. And more so importantly, time spent per user per day is now above 30 minutes, which was up from previously 25 to 30 minutes, which is probably the key metric that we look at when we look at social media companies. And Snapchat is probably, I mean, it's ahead of Instagram, WhatsApp, Twitter for sure, and kind of in the levels of Facebook. So very, very strong on that front. Also, we're seeing an increasing shift from media money and interest going into Snapchat. NBC Universal invested $500 million at the Snap IPO, and the New York Times became one of the newest members of Snapchat's Discover channels. Obviously, Facebook has been, the big competitor together with Instagram. They've had over 30 attempts to copy Snapchat for the last 2.5 years. We think that Instagram in specific is going to be the competitor. Facebook not so much. Facebook is really a place where things are shared that are trending on the web, but not so much personal content. Instagram, on the other hand, is that personal content sharing platform. And with 200 daily active users, larger than Snapchat. However, keep in mind, Instagram's users come much more from countries that Snapchat is not focused on. The one key difference today, Snapchat is still very much, it is video-centric, and that's first and foremost, versus Instagram being more of a picture and an image-centric platform. Obviously, they're trying to change that, so we'll see how it plays out. And also the engagement, that will continue to be very, very key when comparing the two platforms. Some of the near-term drivers will include augmented reality, and Snapchat already launched kind of new lenses and filters about 2 months ago that feel a little bit like Pokemon Go included in Snapchat, and I think this is going to be a big driver for the foreseeable future. Also, localizing the Discover section. The Discover section is essentially that section of Snapchat where media partners can expose their content. So now Snapchat has a local Discover section in France, in Germany, in the UK, and as they're starting to be more and more popular in other countries, they will also focus on creating that. One of the nice side businesses that they have is spectacles. It started as an experiment. It has really shifted to be a kind of a good, money-generating side business, and also a great marketing product for them. And then the last thing I would say is one of the near-term drivers will be, besides just engagement and user metrics, also on the monetization side. Right now, the only focus really is in the US. If you travel to Europe, you will rarely see any ads. The ad load is very low, and I think there's going to be a lot of leverage, and the company can fine-tune that and basically increase the ARPU as they want. With that, I thank you, and I hope you enjoyed the presentation.